If you're not careful, the wrong investments in your Roth IRA could cost you thousands in missed opportunities. But the right ETFs, they could supercharge your financial future for decades to come. In this video, I'll reveal the 4 best ETFs to buy and hold forever within your Roth IRA, as well as a few that you'll probably want to avoid since they will quietly drain your returns if you are not careful. Quick disclaimer, I'm not saying that you should invest in all of these at the same time. That sort of thing has more to do with portfolio construction, which I will touch on just a little bit towards the end of this video. A Roth IRA is one of the more appealing retirement accounts for a few different reasons. You'll pay taxes on the money that goes into the account when you get paid from your employer at whatever tax bracket you happen to be in at that point in time. But the magic really happens after you deposit money into the account. If you hold any ETFs within the Roth IRA that pay ongoing dividends, you won't have to pay taxes on that money earned. As the account grows through an increase in the value of the ETFs held inside of it, you won't have to pay taxes. When you sell an investment for a gain within the Roth IRA, they won't make you pay taxes on those earnings. Then when you go to withdraw money from the account in retirement, you won't have to pay taxes on that money either. Since you'll never pay taxes on money within a Roth IRA once it's in the account, realistically, we want this account to grow as large as possible. Think of it like this. Would you rather have a retirement account worth $1 million you have to pay taxes on, or one you don't have to pay taxes on? That was a pretty stupid question. I don't even know why I asked it, so don't answer. Since we want this account to get as big as possible, we'd want to choose ETFs that have a higher potential upside. The first type of ETF that checks that box is some sort of growth-focused ETF. 2 of the most popular are Vanguard's Growth ETF, VUG, and Charles Schwab's US Large Cap Growth ETF, SCHG. They each track different indexes, but are both acceptable enough to invest in and comes down to personal preference. The fees for both of these ETFs are extremely low at 40 cents per $1,000 invested per year. We like low investment fees on this channel, so this gets my personal approval. What's nice about growth ETFs is that they primarily invest in companies that are believed to have strong future growth potential. These companies are often in sectors like technology, healthcare, and consumer discretionary. All 3 of these sectors have the potential for rapid growth because tech is based around innovation, healthcare ain't getting any cheaper and people always need more of it, and consumer discretionary plays into things people want but don't need. Since we live in an overconsumption, status-based economy, people are going to continue spending money on things that they want but they don't need because they can't help themselves. If you look at how the stocks within this type of ETF are broken down, you can see that they're about as large and growthy as it gets. You're not going to find too many other ETFs that are that far up and to the right, but that higher potential upside comes with underlying stocks that are usually more volatile. The next time the economy takes a dump, these ETFs can experience more significant price swings compared to value or income ETFs. Growth companies usually reinvest profits back into the business to fuel further growth rather than paying them out as dividends. As a result, growth ETFs tend to have lower or no dividend yields. This is good for someone who wants their Roth IRA to grow as large as possible. If companies constantly pay out dividends, money is leaving their bank account, which isn't what you want to see. You'd rather have them reinvest the money in a productive way. Growth ETFs are usually a solid choice for investors with a longer investment horizon who are looking to benefit from the potential for large gains over time. Due to the potential for higher volatility, if you're a newer investor who doesn't understand your personal investing behaviors, just be careful before buying this type of ETF. If you get spooked by a large downturn in the short term and then sell off this ETF at the bottom, then that defeats the whole point of investing in this type of ETF. A growth ETF is for people out there who are going to buy and hold without flinching no matter what. That's probably a broader point that I should make here. Just because you want a Roth IRA to grow as large as possible doesn't mean you should take on more risk than you can personally handle. Any sort of investing with a positive outcome depends on putting your money to work and exposing it to some sort of risk. But it doesn't always make sense to swing for home runs every single time. Sometimes accepting singles, doubles, and triples will get you there just fine. That's where something like Vanguard's Total US Stock ETF, VTI, comes into play and is perfect for investing in within your Roth IRA. It's one of those funds that's so adaptable that it can be held within just about any investment account for a few different reasons. This ETF gives you exposure to the entire US stock market. This includes a broad range of companies across different sectors and market caps from large cap, mid cap, small cap, and even micro-cap stocks. Since it's invested in thousands of stocks, it's highly diversified, which means you're investing in the overall US economy rather than just a specific segment of it. A lot of total US stock funds don't actually invest in most of the US stocks out there, but VTI does, which makes it a true total US stock fund and why it's my favorite. This diversification across these different sectors helps to reduce risk because poor performance in one sector or company may be offset by better performance in others. Since the largest companies make up a large portion of this ETF, you can see that it's heavily reliant on large cap stocks such as Apple, Google, Facebook, and companies like that. It's also got a nice balance between blended and growth stocks with a little more emphasis on the growth. On top of that, they only charge a very low 30 cents per $1,000 invested per year. As with growth-focused ETFs, total stock market ETFs are often a solid choice for long-term investors looking for broad exposure to the US economy. They provide the opportunity to benefit from the overall growth of the US market over time. While growth is a main focus, VTI also offers some dividend income since it does include every single company in the US stock market. Although the yield is lower compared to dedicated dividend-focused ETFs, this balance makes it a great fit for a Roth IRA. Help support my little dog Molly as well as the free content on this channel by hitting that thumbs up button. Speaking of dividends, before I finish off my list of best ETFs for a Roth IRA, let's talk about why some ETFs don't belong in a Roth IRA because they're better suited in other types of accounts. If you're an artist or running an online store, I have something pretty cool that I want to show you. You know how running a business can be super rewarding, but also a bit overwhelming when it comes to little details like production and shipping? Well, that's where Gelato comes in. They've made everything so much easier. Here's the deal. Gelato is like having a global production team right at your fingertips without the hassle of hiring and managing it all. They've got this amazing system where you can create custom designs for your products like t-shirts, hoodies, mugs, wall art, or whatever you're into. If you're like me and not an artsy-fartsy type of person, then no problem. You can add personalized elements to your designs with their free tools to make it just right for what your customers like. Here's how it works. Start by creating your design. You can keep it simple or get as creative as you want, and Gelato gives you all of the tools to make it happen. Here's a hoodie I created based on my investing style. Buy index funds and then do nothing. When your customer checks out your store, they can actually customize the design themselves. Add their name, change the colors, or whatever fits their style. And here's the magic. Once your customer finalizes their order, Gelato automatically sends the design to their nearest production partner. So instead of waiting forever for something to ship from halfway across the world, it's made locally and gets to your customer way faster. It's a win-win for everyone. And don't worry, because Gelato has got you covered with over 50 product categories and integrations with platforms like Shopify, Etsy, and Amazon. They also have a 24/7 support team to answer any questions that you have. No need to wait around until customer service is back in the office to get some help. So if you're looking to take your business up a notch without the hassle of hiring a big team, then click the link in the description to sign up with Gelato for free and get 50% off your first order. First up are ETFs that pay a lot of dividends, like Charles Schwab's dividend ETF, SCHG, which pays a 3.94% dividend. At first, you might think it's a good idea to put this type of ETF in a Roth IRA since you won't have to pay taxes on those ongoing dividends. And that makes sense. Logically, it seems like a good plan. But let's zoom out and look at the bigger picture. You have different investment accounts, and each has its own purpose. The Roth IRA is special because once your money is in there, you'll never have to pay taxes on it again. Dividend ETFs usually don't grow as much in value over the long term compared to more aggressive ETFs like ones focused on the total US stock market or growth stocks. Dividends for those types of ETFs are roughly 1.4% per year and 0.50% per year, which are both a fraction of the 3.94% payment of a dividend ETF. By putting a dividend ETF in a Roth IRA, you might miss out on maximizing the account's potential for tax-free growth because dividend ETFs focus more on generating regular income rather than compounding higher returns over time even after reinvesting the dividends. These dividend ETFs would actually do better in a traditional retirement account like a 401k or traditional IRA, where you won't pay taxes on the dividends as they come in. It would make more sense to pay taxes on an account with a smaller balance because of lower dividend returns than to have the smaller balance in an account where you'll never have to pay taxes on it like a Roth IRA. The next type of ETF you'd want to avoid putting into a Roth IRA, if possible, is any sort of real estate investment trust ETF like Vanguard's VNQ or Charles Schwab's SCHG. As with a dividend ETF, REITs are known for paying out higher dividends. In a lot of cases, a REIT ETF is going to pay out more dividends than a traditional dividend ETF. This is to be expected though, since any sort of REIT is required to pay out at least 90% of their taxable income to shareholders in the form of a dividend. Because of that, it makes more sense to hold this sort of ETF in a pre-tax retirement account. Bond funds like Vanguard's BND are another type of ETF that's better suited outside of a Roth IRA. Since bond yields tend to be lower than the returns from stock-based ETFs, holding them in a Roth IRA can limit the account's long-term growth potential. Instead, bond income funds are a better fit for traditional IRAs or 401ks, where their interest can grow tax-deferred and the lower growth nature of the investment won't take up valuable Roth IRA space that could be used for higher growth assets. Once again, the big benefit of a Roth IRA is that it shields growth from taxes, so it's better to fill it with investments that are more likely to grow a lot. That way, you're maximizing the Roth IRA's full potential for compounding over time. Now, is it the end of the world if you do happen to hold a dividend, REIT, or bond ETF in your Roth IRA? No, not at all. No one is going to come arrest you and throw you in jail because of it. But if you want to optimize your overall portfolio properly, then it makes sense to hold them in a pre-tax traditional account. The next ETF that's perfect for a Roth IRA is some sort of S&P 500 fund like Vanguard's VOO or iShares IVV. These ETFs aim to mirror the performance of the S&P 500 index. The S&P 500 index is what everyone benchmarks their returns against because it tracks the performance of 500 of the largest publicly traded companies in the United States. It's considered a good representation of how the overall market is doing since it offers exposure to a diversified portfolio of large cap US companies across various sectors. You'll usually see people either holding this type of ETF or a total US stock ETF as their core US holdings, since they both offer a way to invest in the overall US stock market. The only difference is that a total US stock ETF is going to have these biggest 500 stocks plus all of your mid, small, and micro cap stocks as well. An S&P 500 ETF is market cap weighted, meaning that the larger companies have a greater influence on their performance. As a result, the top companies like Apple, Microsoft, Amazon, and Google hold a significant weight in this fund. When any of those larger companies go up or down in a serious way, it'll have a large impact on an S&P 500 ETF. This might sound like a really bad thing, but it's more of a feature than a bug. As you can see, a small number of stocks, like these bigger ones, account for most of the S&P 500's returns. This ETF is for investors who want broad exposure to the US stock market that offers a balance of growth and a little bit of income. It's a nice, straightforward approach to investing in the overall growth of the US economy without needing to pick a bunch of individual stocks. The fees for VOO and IVV are very low. Both come in at only 30 cents per $1,000 invested per year. An international ETF could be another great addition to your Roth IRA. I personally like Vanguard's VXUS and iShares IXUS. International ETFs like VXUS and IXUS offer exposure to companies across the world, including countries in Europe, Asia, and emerging markets like China, India, and Brazil. By excluding US stocks, they provide diversification outside of the US economy, reducing dependency only on US market performance. Both VXUS and IXUS include companies of all sizes, from large cap to small cap, giving you broad coverage of the global stock market. This means you gain exposure to established multinational corporations like Toyota, Samsung, and Shell, as well as smaller, growing companies from international markets. Since these ETFs invest in both developed markets such as Japan, the UK, and Europe, and emerging markets such as Brazil, China, and India, you get access to economies at different stages of development. This gives you a mix of stability from developed countries and higher growth potential from emerging markets. VXUS charges 80 cents and IXUS charges 70 cents per $1,000 invested per year, which is extremely low cost and very acceptable. Some people really don't like investing in any sort of international ETF, and I get it. When we take into account how US stocks have outperformed international recently, you'd seem crazy for wanting to go anywhere near them. But since we can't invest for the past and the future is unknown, people like me at least want to put some money in this sort of ETF to hedge our bets. If international stocks grow faster than US stocks in the future, you'd want to hold those types of ETFs in a Roth IRA to shelter that growth. This is why I personally invest in both a total US stock ETF and international stock ETF in my Roth IRA over on M1 Finance. This is my #1 place to invest, so if you want to check out M1 Finance, then I'll have a link down in the description below. Now, some of you might not really care about which ETFs you put into a Roth IRA, and if you don't care, then I don't care, because at the end of the day, it's your money, and I'm not your daddy, so do what you want. But if you want to know the best portfolios to put these ETFs into, like I mentioned at the beginning of the video, then watch this video to your left next. Hit that thumbs up button before you go. I'll see you in the next one, friends. Done.